we have had some extremely exciting stuff between uh, grain markets, oilseed markets, beef cattle markets, and all these other factors that have been playing into this market. I mean, I'm always amazed at at what can influence our markets, and that we have no control over. So I'm going to kind of give my general spiel on things, but I'm also going to hopefully institute some of these other things. Here we've got JBS being shut down for a couple of days in different places because of a cyber attack. And, same thing Aaron was talking about, fuel prices. Well, the whole East Coast, was essentially shut down uh, due to a cyber attack. And, when your country is crippled by their fuel and their food, um, you realize how fragile certain things are, and that really starts pulling on dollars when those types of things happen. And so, what we've been seeing is these volatile corn prices have just resulted in a lot of pressure on feeder cattle. And we look at cash prices locally versus uh, futures prices. And so, it's a balance of what you're looking at there, because a lot of people just strictly worry about what the cash price is today. And we've actually started to see some strengthening in those cash prices. I think the CME feeder cattle index actually got up to about 140, 141 yesterday. And, that's a really positive improvement over where we've been, considering it was down in 135 to 137 range. So when you get $5, $6, $7 improvement, that's a positive sign. But we've seen these futures prices just all over the place because of expectations. Of course, there are some issues in Brazil that have influenced the grain markets. China has influenced grain and oilseed markets, and all those things end up playing into feeder cattle prices. Uh, in other words, feed prices have a whole lot greater influence on, or grain prices have a whole lot greater influence on feeder cattle prices than feeder cattle prices have on anything to do with grain markets. Uh, but these is a balancing act that we have, and this is where diversification, crop and cattle producers having that diversification really helps. But most of us are one or the other, and so we need to think about what we can do during that time period to manage some of that risk. Drought's been influencing heifer retention in western states. There's, last year Colorado was where we saw the biggest decline in the beef cow herd, and I can guarantee you they hadn't been able to rebuild because most of the western states, as well as the northern plains, have been in terrible drought. Before most people got on, I was talking to Aaron about talking with a fella in North Dakota, and just a bunch of cow calf pairs being moved up there, and those animals are having to go somewhere. And if they're selling them as cow calf pairs, they're going to a place where there's more grass right now. But what that means is those producers aren't being able to get back to their herd size that they were wanting to get back to, and so that might be a positive thing looking to cattle prices a year or 2 years from now. Um, but right now, the cattle prices are not exactly where we want them to be. I tell you something that has really been amazing to me is how steady this slaughter cattle market has been. We've been in a range of 118 to 122 for 2.5 months now, and that's just unheard of this time of year, because typically we see these animals, these animals going to slaughter. Prices will peak in April, early May, as we kind of go towards the unofficial beginning of summer with Memorial Day holiday. But uh, it's just been so steady. And actually, we've been trading in 119, 120 for 4 or 5 weeks now. I mean, it has been as steady a market as has been since I've been in this position. And I guess I've been doing this job for a little over 9 years now. And this is the most steady market uh, from a slaughter animal that I have seen in those 9 years. And if you go back in history, I think you would find that this is the steadiest market that we've had in even more, I mean, a long time. It's hard to know what will happen, but the futures market has actually got a really, really strong summer market for us. That's a good thing for feeder cattle producers, but it's hard to understand how a feedlot who is getting paid 119, 120, and is looking at $6 corn and paying $1.40 for an 800-pound steer, uh, they're going to run out of dollars pretty quick that way. The profit margin just is not very positive in that. I mean, most of them are negative. Uh, Now, a lot of those people at the same time have been using the futures market to their advantage, and and have benefited greatly from that. Uh, but on a cash to cash basis, it's making it very, very difficult. Uh, I realize we probably got some stocker producers on here, and buying back some cattle this spring. If you were buying any cattle this spring, I'm not sure that it was probably smart to hedge them if you bought them when you bought them. It's essentially what I'm saying is it's probably smart to have sold them on the futures board at the same time you bought them. Um, but we are starting to see some moderation in these lightweight calves. Starting to see less demand for these grass cattle. Of course, the Flint Hills of Kansas, they're trying to stock pastures right now, trying to put a lot of cattle uh, on grass, and they're probably stocked though, so that this price is going to continue to decline. Um, Last year we saw a very, very steady price throughout the summer and most of the fall months until we really hit when real fall marketing hit in October and November. But we'll talk about where we think prices are going to be on those. Uh, this is just a weekly auction run of 7 to 8 weight steers. But last week we had a lot of, and actually this week we've had a lot of cattle trade uh, of yearling type cattle, and we've got a lot of these eight eight to 850 type cattle, even up to 9 weights. Trading in that around $1.30 to $1.35 on some of those cattle. So when we can move $1.30 to $1.35, 850 pounders, uh, we probably were able to make money on those cattle given where they were bought last fall or winter, or even in January and February. A lot of those cattle probably made money for those producers, which is a very positive thing. It's just the feedlot probably didn't make a whole lot of money. Um, the market that has been tremendous, tremendous, tremendous is the slaughter cow market, and the reason for that has largely to do with our imports of lean grinding beef, which are down considerably, and I'll show that graph here in a few minutes, but um, we've really reduced the amount of lean grinding beef that we've been importing, and that's primarily because of Australia being in drought. Because most of our lean grinding beef comes from Australia, and they've been several years of drought. They're now trying to recover from that. They're rebuilding their herds, so they're not exporting as much beef. That's also promoted our beef exports, which I'll show that as well. But that's a different market. So this slaughter cow market has been very strong. It typically peaks in the June time period. I think we're going to have a lot steadier market, just like we did last year. I don't think these prices are going to fall off as quickly. But if you do have if you do have some cows that need to be culled, if you're in that situation, you got the bull out there right now. Maybe doing a preg check on cows immediately following the calving season or the breeding season would be very wise to go ahead and if they're open to go ahead and sell those animals, or if they're just poor producers or they're old or whatever it be. I think if you get these marketed in July or August, I think you'd be very, very pleased with the price that you receive on some slaughter cows. Just to briefly show you where we are on slaughter year to date, heifer slaughter's up nearly 10%, steer slaughter's up 10%, and beef cow slaughter's up 10%. Now, a lot of that increase has to do with the fact that we've already hit the time compared to a year ago. We really saw slaughter slack off because of COVID-19 as facilities shut down. But even if we had last year, if last year would have been similar to 2019 slaughter, we would still have heifer, steer, and beef cow slaughter up 2 to 4%. That's a big deal because that means we got more meat on the market. We're putting more meat on the market. You can see here how that looks on the graph for heifer slaughter. that big decline in the dotted line would have been the coronavirus taking effect in a lot of these slaughter facilities. Uh, Heifer dress weight, just throw this out there real quickly. We had weights really, really high to start the year. We're starting to get more current in our marketings. So that means we're working through these animals at a pretty quick pace, which is a good thing because we don't need these overweight animals. You know, we don't need to just keep on feeding and feeding, 3 weeks. Here we got an animal that's ready to harvest, and then we had to feed it 3 more weeks. The same thing can be seen in steer slaughter and steer dress weight. Um, but what that does is it gets us down to this total meat production, and again, total beef production being up 9.6%. Part of that is because of, compared to last year, you had coronavirus. But the truth of it is we're moving a lot of meat and at really, really strong prices, which tells me that domestic and international demand for U.S. beef is strong. People keep on wanting to say, well, when will the consumer stop buying beef? And when will they do this and when will they do that? Well, they haven't shown signs of fatigue really. The international market is starting to show a few signs of fatigue. Um, we'll actually get some trade data out today for the month of April, uh, but and it might show us a slow up in beef exports. But for the most part, we've had strong beef demand, which is really, really positive. Um, for the industry. The problem is that the only person in the industry that's really capturing all this value is the packer. Um, and y'all know how the legislation uh, has been going with that. There's a lot of people that are calling for legislative uh, involvement in price transparency, price discovery between the packer and the feedlot. And actually, I've got a call today that I've got to be on that's actually in relation to that subject. Excuse me. And and so, you know, what we do know, I mean, as from the cattle industry, most of us are very independent type people. Uh, Anytime you have government intervention, there's an additional cost associated with government intervention. So if you can come to a solution without government intervention would be the best thing. Um, and in my own personal opinion, to me, if the feed yards think we need more price transparency and more price discovery, well, then start selling more cattle uh, in that manner as opposed to formula. Start actually negotiating prices as opposed to selling by formula. But what we know is that the formula pricing of cattle reduces transaction cost, and so that's why they do it, and they see benefit from it that way. Pork production has been very, very, very strong. We've continued to send a lot of pork to China as well as beef. Broiler production is on par. Uh, I think it is kind of interesting to note that our beef grading choice has declined a little bit relative to a year ago, but we still got a lot of beef grading choice. We got a lot of beef grading prime. We have really improved how cattle grade. A lot of that's through genetics. Some of that's through how we feed cattle, but most of it's through genetics that we've seen uh, by our seed stock producers. They've done a great job of focusing on carcass quality, but as producers, we've still got to remember some of those other things. Uh, Aaron and I were talking earlier about some of the work that we've been doing with repro in beef cattle and the importance of repro to the bottom line. And you don't want to give up uh, producing a calf because we do realize that we need to be hitting weaning and marketing 90 to 94% calf crops every year if we want to be profitable. And if the way carcasses grade, uh, if that's what you strictly focus on and you lose out on conception rates and weaning rates, then we might need to reevaluate. But there is a lot of value in carcasses that grade well. So overall, there's a lot of meat available. There's no shortage of meat out there. The problem is there's a lot of money being paid for meat. It's just not this whole trickle down effect that they talk about we've not seen any of that yet. Eventually the feedlot will gain leverage and some of those dollars will come back down into the stocker and cow calf sectors, but we're not going to see the type of profit that Packers saw. So, you know, China it's always so fickle. China has become the number 3 beef export destination since last April. Um, so April a year ago, they started really importing beef, U.S. beef, in April a year ago, and it really took off in June and July. And they have now become the number 3 destination, which is a great thing. I mean, a population of 1 billion, start sending them some beef, right? But they've been importing a lot of pork, a lot of beef, a lot of corn, a lot of soybeans. Um, and Japan and South Korea are still really strong markets. Japan has traditionally been our number 1 market, and they continue to be. But South Korea is starting to compete with Japan on being the number 1 market, and that has a lot to do with the trade agreement we have with South Korea and their need of our beef. Both of these countries, uh, you know, we've seen strong exports, largely because Australia does not have the exports to put into them. Same way with China. You know, Australia would have been exporting a lot of beef to China, but because they cannot export as much beef because they're trying to grow their beef herd, we've been able to take advantage of that situation. And good thing that things are improving in Mexico because they're starting to take in more of our beef products. When coronavirus took hold, their economy got really bad, and so they slowed down on importing U.S. beef. But things are starting to pick back up, and them and Canada round out the number 4 and 5 uh, countries for what we're doing here. So here's our specific imports. You can see how they're down compared to a year ago, slightly. Um, you know, not huge changes, but what I think the key thing here is look at these exports and how strong they've been. You know, other than during that coronavirus, if we wouldn't have had the coronavirus pandemic, we would have had an extremely strong 2020, and we started off 2021 extremely strong. This simply points to how strong a demand we have for beef and veal exports in our of U.S. beef. Here, I really like this graph right here. I mean, I always show it. This price comparison here of year over year prices, but you can easily see the price spike that we saw during the coronavirus pandemic. But I think it's even more impressive, and I realize that that solid blue line there is not to the nominal value of 450 or 460 or whatever we reached last year. But I think the long-term beef prices here, if you see how steady that increase is, and the fact that we're at this level that we're at right now in beef prices, I don't think we're going to see a sharp decline like we did a year ago. They're probably going to peak here in the next few weeks, and they're going to slowly decline. But having those strong prices over that long of a period is going to bode well for the industry, because during that time period, I do think that's when these feedlots will start gaining a little leverage, and they're going to start passing down some of these dollars to the feeder cattle level. Aaron already showed the drought monitor, and yeah, there's a lot of cattle country that's dry. You know, we had some time, I think, in a lot of Tennessee that we were getting a little dry. East Tennessee definitely had it the worst, but there were places in Middle Tennessee that at least in the 2 different places I have cattle, that we were getting dry. And you know, any place that you had rock that was close to the top of the ground, everything was turning brown. But we've got some recent rainfalls. The southeast is, for the most part, in pretty good shape for pasture conditions. Sorry about that. Let me back up a second. Here's U.S. range and pasture conditions, percent poor and very poor. Most of this 40% that are rated poor and very poor really come into the plain states in the western region. So if we look at the Great Plains, things have improved a little bit since early May. but they're still in poor conditions. And that's the thing, that they ended the year last year in very poor conditions, which again will hurt this year's production because they ended up with poor soil moisture last fall. And so when we go into the Southern Plains, things are not great in the Southern Plains, but they're not terrible. They generally have drier weather there. In the Southeast, we're in pretty good shape. Hopefully, we'll maintain pretty good moisture. You know, we've got a pretty good 10-day outlook for moisture, and hopefully that'll continue to promote forage production. Probably the best thing that we're seeing for the next 4 or 5 days is temperatures being 85 degrees or a little lower. I did see some 90 degrees chirping into that 10 and 14-day forecast, which will shut down a lot of our cool season grasses. But 85 degrees, we'll still see some of these cool season grasses with good moisture trying to grow a little bit. Again, go back to look at Omaha corn prices. You know, when the feedlot's having to pay $6.80 for corn, that's going to end up putting expected cost of gain in the feedlot probably $1.10, $1.15 type range. That's very, very expensive, which means they're going to have to pay less for feeder cattle if they're going to maintain a positive margin. But what we know is cattle feeders don't always maintain positive margins. Not going to talk a whole lot about hay prices. Our hay production in the state, I think, is very, very spotty. Locally, where I am in Middle Tennessee, probably 70 to 80% of normal production is what we're experiencing this year for most hay crops. You know, I don't know what it is across most of the states, but I've heard several others in other states say that that hay may be a little thin in places. I did see some really, really strong wheat hay yields this year in several different spots. So maybe some of those alternative hay options are going to keep us in the black on hay. I don't know. We'll just have to wait and see. Here are the closeouts for Kansas feedlots as of late. For cattle that closed out in April, it cost 96, 97 cents to finish out those steers per pound. Pretty strong price, but like I said, we're talking about it being $1.10 to $1.15 based off of current corn prices for those being placed if those prices maintain themselves. Now, here's where I want to talk. This is the August. If you want to forget everything else I've already said, I think price risk management has been the producer's friend this year. And actually we saw the same thing 2 years ago, this same situation set up. This is the August feeder cattle futures. So, you know, we're only 2 months from there, but I'm also going to show the October. And as I said, the CME feeder cattle index, which should converge to this August price in August, is trading around 140, 141. So right now we're looking at an $8 difference between the two. And somehow or another, these two prices are going to have to converge to each other. And I you know, I'll tell you, I think I hedged I've got a hedge at 154 on August myself. I helped some others get a little higher price than that. I guess I'm better at helping others than I am at helping myself sometimes, but you know, I'm tickled to death. I have a 154, and actually I still hope that the index gets to 154. I'd be tickled if feeder cattle got up to 154. But the thing is do you think we've got $8 more in feeder cattle from that index to the current 149? Do you think we've got $8 of upside in the cash price? And we definitely could have $8 of upside. But what's going to have to happen is that corn prices are going to have to decline quite a bit, or live cattle prices are really going to have to escalate. And I don't see live cattle prices escalating during the summer. So I think we're going to have to count on corn prices to decline. And I don't know that we're going to see some huge decline in corn prices, especially based off of what Aaron has already said. but beyond August, because August is a short time frame, if we look at October trading at 154 right now, now you're talking about a $14 differential between the current CME feeder cattle index at 140, 141 to the October futures price. And I'm not a big fan of a straight hedge here. I'm not a big fan of straight selling the futures because of how much volatility and exactly what Aaron mentioned of those margin calls. It's fine. I don't think there's a problem with them if you have the funds and you work with your lender to make sure you have the funds in the account to hold this position. A straight hedge would work fine. But if that's not something that you want to do, I think there are some other alternatives that are beneficial. But do you really think, this is not me saying that this is going to happen or not going to happen, but do you think we've got 14 more dollars of upside in that cash feeder cattle market? There's no doubt that we have seen feeder cattle markets increase 14, $15 between June and October. That has happened. That is possible. It's not that, I mean, and it has happened several times. So it's not out of the question. It's just a matter, do we believe the fundamentals will actually push it there? And so to me, futures traders have really offered some opportunities, and you can see how we've got up to nearly 164 at one point on this back in April, early April. Do we think we're still going to see that continue? I don't think we're going to get back to 164 to trade that high again. But I do think that the current marketing opportunity is there. And for smaller producers, LRP has offered some really good alternatives. If all you need to cover is 5 head, then you can cover 5 head through LRP. And I'm not the hugest proponent of LRP, but since they've made all these new changes, it's hard to know if it's a good alternative. And we are trying to do some research in that area. So with that, my price forecast for fed cattle can be seen here. I think we're going to have a strong summer. I really do. The fourth quarter, I tell you, I really think fourth quarter, when we get in November and December, we're going to see some really, really strong prices for fat cattle. And I've got a really broad range for the first quarter of 2022, but I think we're going to be on the upper end of that as well. So we can look at that. But here looking forward into August, September, October, November marketing time period, which is when a lot of people are going to be marketing 8-weight steers and 550-pound animals. Here's those price projections. We've definitely got some opportunity here for upside, and you can see I've got the market moving higher between now and August. I do think the market will be higher between now and August. How much higher, it's really hard to know. But if we're selling 8-weight steers at a $140, I think there'll be a whole lot of people that'll be tickled to death for 8-weight steers at a $140. And if you're selling a 8-weight heifer, 800-pound heifer at $1.30 or something, $1.27 to $1.30, a lot of people will be tickled. I do think the fall run of calves is going to have a little stronger price than we did a year ago. So those are all things to look forward to.